Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. We've gone ahead and rolled over to the July corn contract, and what we'll notice here are two key factors that have taken place. Number one, we've entered into our time region where we believe a potential change in trend could occur. And in addition to that, the market came up into resistance. And you'll notice over the last 3 or 4 trading days, the market hit resistance and really had a very strong reaction to the downside in conjunction with our time factor for a potential reversal. At this time, we believe that corn can come in and perhaps touch somewhere in the neighborhood of 360 to 365. And so right now, the downward pressure that we're seeing is consistent with what we've understood for current market cycles. In making the adjustment to the new contract, we also have a new natural box support resistance threshold to look at. You'll notice here that the high that was made a few weeks ago hit exactly at a perfect timeline for a downward sloping natural trend line. Also, currently we have our point of control sitting at 432.5 to 432.75, which is probably very unrealistic, which is well above where the market is right now. The areas that are of particular interest for us currently would be the 390 area, which is very close to where we saw current resistance, as well as one standard deviation below that level, which puts us at 362.5. 362.5 then becomes a very realistic spot for this corn contract to drop into, where it could very well find some support and either trade sideways or continue lower from there. But for now, we really believe that we have very good resistance at the 390 level, and perhaps the market can trade sideways inside of that 360 to 390 band. The December contract delivers a very similar price action movement itself, and here we'll notice that the point of control sits at 391. Currently, the market's trading at about 387, so we're just below that point of control. As long as December corn stays below this point of control, the next level down below we're looking at for potential support would be 378.5, and then 364 below that level. These two areas are going to be very important for this contract. With overhead resistance sitting at that 391 level, we understand then that the supply narrative continues to be bearish, and so outside of something really spectacular happening, we really believe that corn now entering into its current cycle should trade sideways to down. July beans has been trading very well against its natural support and resistance levels that we have marked out for you. Currently, it is sitting inside of a very important band of 1028 to 1043.75. Below 1028, we anticipate continued weakness, and above 1043, we believe that the next area of key resistance is going to be at about 1063. At 1063, what we're looking at then is a potential movement that would come in over the next couple days or into the rest of the week, where the market would then look to find prices drop, and then after that drop, we'll see one more final advance that potentially looks to test that 1063 area, at which point we believe a final top can come in. Now, the market could come in and make a top maybe near 1100 or so, but beyond 1100, we believe is very unrealistic for this current price action movement to achieve or get above. Upon getting to its next level of key resistance then, we then are looking for the soybean market to then decline into the summer months. When we have a look at our key point of control levels, we'll see here that prices are currently at about 1040, and 1036.75 is the final point of control threshold that we have for this current market movement. Above there, we have resistance at about 1070, which is very close to that 1063 number that we were looking at. So with the confluence of the 1063 coming in with the 1070, again, we really believe that this is going to be a very challenging area for it to get through, although the possibility of 1100 still remains, but beyond 1100, that too is very unrealistic. Now, we do have the capacity for weather events, etc., to change the nature of the dynamic of what we're looking for, but really the information that we're seeing and helping us to understand continues to be technically to the bearish side. We do have a caveat with regards to funds right now. They have turned over to being net long versus net short, and that's the first time that this has occurred in quite some time. And so right now, some of the speculative trading on the professional side is starting to look for potential upside potential to capture some near-term gains there. So we want to be very cautious as we navigate through these markets, and we do want to make sure that we're capturing potential profits depending on where we sit on the market right now. As far as the November beans contract is concerned, an argument can be made that we are in the midst of a potential continuation pattern. Although we've had one already that had a very strong impulse out of the market, followed by another continuation pattern by another impulse move. So the number of impulse moves that markets will typically see will at some point in time start to diminish or start to stall. So when we look at this current movement right now, we have to consider where the key resistance lives. One standard deviation away from the point of control sits at 1024, and then another deviation just above that is at 1063, well above the market here. So our levels again continue to find confluence up near that 1063 to 1070 number, and so a break from this area could again potentially make a rise up to those levels, but it needs to definitively find some strength outside of the current areas in order to really be able to hold on. And so we want to make sure that we're now watching some of these key levels of support and resistance as the market makes its iterations. The movement that we're seeing in the July wheat contract is very consistent with expectations. We came up to volatility-based resistance. We have since dropped from there in a strong fashion, and what we're noticing now is between the 180 and 270 mark, the market is finding a little bit of sideways movement inside of here. In conjunction with that sideways movement that it's doing, this support now is coming in very close to potentially being oversold, which tells us that as long as the market sits inside of this zone, we'll continue to see a sideways movement, but a break below 465 should send prices down to about 445 or so. And so it's going to be very important to see how the market reacts against this 270 area should it get down there. A couple levels for us to note here with regards to the July wheat. The point of control is at 482.5, and just previously on the last chart, that 180 degree mark sits at 487. So between 487 to 482 was a very important level. A clean break through that number sent us back down to the threshold of 270 degrees. And once and if we're able to break through those lows, then that 440 to 450 number is perhaps a very good target zone for the July contract. In closing, we are particularly excited about how the crude oil contract has really panned out for us. In our last session, we suggested that a possible wave 5 top was coming in conjunction with our resistance level here, and we also had resistance that was volatility based as well coming in for this contract. All of these pieces really came together in conjunction with time, and on Friday the market made a high just 2 cents shy of what was our projected resistance level and has been moving down since. And so for those of us who were able to take or participate in shorting the market, there is already about $2 to $3 in the money and could very well be risk-free, especially if we faded up against that resistance level. We'll continue to monitor how this contract continues to move, but as mentioned before, what we've seen historically in the past is when the market comes in inside of one of these projected turn time zones, whatever the market was doing as it comes into it, we'll often see a change in the trend that it has been exhibiting. So if the market was in an uptrend, it might go sideways or down, etc. So what we're looking at here is for a potential move that continues to go down and perhaps maybe finds a target at about $39 to $40. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.